2000, a man named Bill Miller had just finished beating the S&P 500 for 15 consecutive years. 15! People called him the greatest investor alive. Magazines put his face on covers. Institutions handed him billions. And then he loaded up on financial stocks in 2007, right before the worst financial crisis in 80 years. His fund lost 65% in a single year. The man who beat the market for 15 straight years got wiped out because he thought he understood the market. I'm telling you this because the same trap is happening right now, in 2026. Except this time, it's not one legendary fund manager. It's millions of everyday investors loading up on the same 7 stocks, following the same headlines, and making the same fatal assumption. They think they understand what's happening. They don't. And by the end of this video, neither will you, in the best way possible. Because when you finally see 2026's market for what it actually is, you'll make decisions most people won't even consider. Here's what the market is not telling you. Let's keep this fair. Meet Jake and Marcus. Same age, 29. Both working professionals. Both earn $70,000 a year. Both opened brokerage accounts in 2021 and have been investing $500 a month ever since. The only difference? What they bought. Jake did what every finance influencer told him to do. He bought the S&P 500 index fund. Broad, diversified, passive. The strategy Warren Buffett himself recommends for regular people. Jake feels smart. He's heard the data. Over 90% of actively managed funds underperform the index over 15 years. He's not gambling. He's following the math. Marcus got curious in late 2024. He read about AI. He read about NVIDIA's revenue growing 200% year over year. He started tilting his portfolio toward the Magnificent Seven, the 7 mega-cap tech companies that have dominated the S&P 500's returns. Apple, Microsoft, NVIDIA, Amazon, Alphabet, Meta, Tesla. He feels like he's making a sophisticated call. He's not just buying the market. He's concentrating on the best part of the market. By early 2026, both of them look like they're winning. Both portfolios are up. Both feel confident. But here's what neither of them realize. The whisk they're carrying is not the same whisk, and the market doesn't care what they think they own.
On every visible scoreboard, the last few years rewarded both of them. The S&P 500 returned over 24% in 2023, then another 23% in 2024. Anyone who stayed invested looked like a genius. Anyone who concentrated on tech looked like a bigger genius. NVIDIA went from roughly $150 a share in early 2023 to over $800 by the end of 2024. Microsoft crossed $3 trillion in market cap. The AI narrative was everywhere, and the earnings backed it up. These weren't speculative bets. The revenue was real. The growth was documented. The story made sense. But here's what's happening underneath the surface that nobody's financial app is showing them. As of early 2026, the top 7 companies in the S&P 500, that's 1.4% of the companies, represent over 33% of the index's total weight. Let that land. You buy an S&P 500 fund expecting 500 companies. You're getting, in effect, a 33% bet on 7 of them. Back in 2000, the top 7 companies made up about 18% of the index. In 1990, closer to 12%. We have more than doubled the concentration in 35 years, and almost no one is talking about it. Jake thinks he's diversified. Marcus thinks he's smart. They're both right, and they're both walking into the same trap. Here's what happened to the last group of investors who thought exactly like Jake and Marcus. It's 1972. There are 50 stocks the entire investment world agreed you could buy and never sell. The Nifty 50. Polaroid, Kodak, Xerox, Avon, the most dominant companies in America, trading at 60, 70, sometimes 80 times earnings. People said valuation didn't matter because growth was guaranteed. Then 1973 happened. An oil crisis, inflation, a mild recession. The Nifty 50 didn't just drop, they collapsed. Polaroid fell 91%. Avon fell 86%. Xerox fell 71%. If you bought at the peak in 1972, some of these stocks took 25 years just to break even, not adjusted for inflation, in nominal terms. A quarter century of zero. The investors who got hurt weren't reckless. They were following the consensus. They were buying the best companies by every visible metric. What they missed was the structure of the bet they were making. Sound familiar? Now look at Nvidia in 2026. Incredible company. Revolutionary technology. Revenue growth that has been genuinely staggering. But the stock went from roughly $150 in early 2023 to over $900 by mid-2025. That's a 6x move in under 2.5 years. Revenue grew significantly, but not 6x. What grew 6x was the multiple investors were willing to pay. The valuation expanded because the story was compelling. And here's the part that should make every passive investor stop and think. If Nvidia drops 50%, not a crazy scenario given that this has happened to every high-flying tech stock eventually, including Nvidia itself in 2022, that single stock's decline takes nearly 4% off the S&P 500 alone. Add in a similar correction from Apple and Microsoft, and a portfolio that looked diversified is suddenly down 15 to 20% before the other 493 companies do anything at all. For context, Nvidia fell 66% in 2022 in 12 months, then recovered and kept climbing. Volatility at this scale is normal for this stock. This is what financial academics call concentration risk, and the system is designed to hide it from.
They call it an index fund. The word index sounds safe, sounds boring, sounds like you're spreading the risk. But an index that weights by market cap automatically puts your money where prices have already gone up the most. You're not buying the market. You're buying the expensive part of the market. Every month, automatically, without thinking about it. That 1% annual drag from concentration, from holding overly valued, tightly correlated assets, doesn't sound like much. Over 20 years, on a $200,000 portfolio, it's $94,000 in lost growth. Not from a crash, from the slow bleed of holding a concentrated bet dressed up as diversification. The flip happened quietly, but it happened. If I left the story here, I'd be doing exactly what I accuse the market of doing, telling you half the truth. Standard S&P 500 index funds are still better than almost every actively managed alternative. The data on this is settled. According to S&P's SPIVA reports, roughly 90% of active fund managers underperform their benchmark over 15-year periods. If you're choosing between a financial advisor picking stocks and a low-cost index fund, take the index fund. Every time. And those 7 mega-cap companies, they might keep going up. Nvidia might hit $5 trillion in market cap. AI might justify every dollar of valuation the market has assigned. Nobody, and I mean nobody, can tell you when the music stops. The argument isn't that these stocks will crash tomorrow. The argument is that you should know exactly how concentrated your bet is before you make it. And right now, most people don't. Notice the pattern. The cases for staying fully concentrated in a standard index are real, but they're conditional. They all require the current trend to continue indefinitely. And historically, that assumption is the most expensive one an investor can make. Jake and Marcus both walked into 2026 thinking they were being smart. Jake because he followed the data, Marcus because he followed the narrative. Neither of them sat down and asked, what is the actual structure of the bet I'm making? Bill Miller beat the market for 15 years, and then one concentrated bet, one assumption that the trend would continue, cost him everything he'd built.
The real trap in 2026 isn't stocks. It's not even concentration. The real trap is the assumption that what has worked for the last 5 years will work for the next 5. That assumption is how every financial crisis in history started. The Mississippi Company, the Nifty 50, dot-com stocks, housing in 2007, the pattern is the same, only the costume changes. So here's the question I want you to sit with. Not whether the market will go up or down, but this. Do you know what you actually own? And if you had to explain the exact risk in your portfolio to someone you care about, could you? Because that's the only question that matters. If this video made the risk feel real for the first time, if you looked at your portfolio differently in the last 10 minutes, do me one favor. Hit subscribe. Not because I'm asking nicely, because next week we're running the real math on what a 30% market correction does to the exact portfolio structure we talked about today, month by month with specific numbers. And the results are going to make a lot of people very uncomfortable. And if you know someone who keeps saying, I'm just holding the index, I'm fine, send this video to them. Not to scare them, to give them the information they deserve before they need it. Drop a comment below. What percentage of your portfolio is in the top 10 holdings of your index fund? Go check right now. I'll see you in the next one.